Have you ever wondered what truly sets apart the investing giants from, well, the rest of us? The markets are definitely alluring, promising wealth, yet they often feel like a perplexing maze, don't they? Today, we're embarking on a deep dive into some truly fascinating insights that challenge traditional thinking and maybe offer a roadmap to cultivating the mindset of a truly successful investor. We've drawn from some incredible sources, really rich with wisdom from a seasoned expert in the stock markets. It's a perspective that goes beyond just quick tips. It delves into the psychology and the strategy behind real long-term wealth. Our mission really is to extract those crucial nuggets of knowledge, things that can help you navigate the complexities, spark those aha moments, and maybe most importantly, reshape your entire approach. So let's unpack this journey.
Yeah, and what's often misunderstood, I think, is the very nature of markets themselves. There's this common misconception that they're just, well, random, like pure chance. But our sources emphasize quite strongly, actually, that markets are not a roulette wheel. They're not random number generators.
Yeah.
They are, in fact, structured and incredibly unforgiving. Even when things look chaotic, there's often a pattern underneath it all.
Right, and it's this structure, this inherent logic, that largely explains why true investing success is just so rare. We're seeing Pareto's law in action here, aren't we? That idea that a small percentage of efforts or investments give you most of the returns. The experts suggest that out of India's massive population, maybe, max 50 people, consistently achieve truly significant wealth in the markets. That's an incredibly exclusive club.
It absolutely is a tiny fraction. And this isn't just about getting lucky, not at all. The markets are fundamentally almost designed for people who are sincere, committed, hyper-intelligent, have an understanding of history, and possess the personality to actually engage with markets well. It really demands this unique blend of intellect, discipline, and crucially, emotional resilience.
Okay, so if that's the profile of top performer, what typically trips up let's say, the average investor? Someone who might have the capital, but maybe not this specific demanding skill set. What are the common pitfalls?
Well, more often than not, it really boils down to emotional biases. That's the big one. Our sources highlight that an average investor's return is always 2-3% less than our market portfolio's returns. Why? Because they enter at the wrong time and exit at the wrong time. Simple as that, but so hard to avoid. They frequently fall prey to what's termed communal greed, buying into the hype when everyone else is.
FOMO, basically.
Exactly, fear of missing out, and then personal fear, selling in a panic when things look bleak.
It's such a powerful point. Now, okay, disciplined investing, like just consistently putting money into index funds, that can certainly lead to substantial wealth over time, right?
Yeah.
Growing, say, 5-7% faster than fixed deposits. But the expert draws a very clear line here. That's different, he argues, from wealth creation. That implies significantly higher transformative returns, the kind that can genuinely change your financial life. It sounds like two entirely different games. It is. They are very different objectives, requiring different strategies and mindsets. Indexing is great for steady accumulation. Wealth creation is about finding those outsized opportunities. So if we're aiming for those transformative returns, what's the underlying philosophy? It clearly requires a mindset that's, well, different from the traditional buy and hold everything approach.
All right.
Yes, the core philosophy is about cultivating personal greed, which sounds maybe counterintuitive, but it's distinct from communal greed. Let me explain. Our source puts it like this. My greed should not be communal, it should be personal. That happens when the entire world, the community, is selling. The market is breaking down, it seems like the world is ending, like during COVID. That's when you have to position size. So personal greed here means strategic, contrarian action. It's driven by your own conviction when the wider market is gripped by fear, rather than just following the herd mentality.
Okay, so it's about strategically scaling into positions when market panic is peaking, and then maybe gradually exiting when that widespread euphoria takes hold. It's really about having the conviction, the guts maybe, to be bold when everyone else is fearful, and then exercising caution when others feel invincible, like nothing can go wrong.
Absolutely. That's the essence of contrarian thinking in action. And the power of writing a truly exceptional stock, what's sometimes called a 1000x stock, is just immense. Think about a legendary investment, like the one Rakesh Jumjanwala famously made in Titan. Such a stock, a real outlier, can absorb many losses and essentially nullify them. It demonstrates how these high-growth opportunities can disproportionately offset multiple smaller setbacks in a portfolio. They become crucial for achieving those truly outsized returns.
Right. And this, I suppose, leads us to confront a pretty stark reality about stock performance. It illustrates just how skewed this game really is. The sources paint a rather sobering picture for us, actually. Get this. Over the next 20 years, roughly 2,500 out of 6,000 Indian companies are projected to trade below their current price.
Wow. Below today's price 20 years from now.
Yeah, and a staggering 80% of companies, 80%, will likely deliver lower returns than even fixed deposits.
That's most companies underperforming the safest option.
Exactly. But conversely, a tiny minority, just 50 to 75 companies, will account for the vast majority of all the money made in the entire market. It just means, doesn't it, that if you're just picking stocks randomly, the odds are heavily, heavily stacked against you.
Heavily, which underlines why a disciplined strategic approach is so vital. You can't just throw darts.
So if only this handful of companies are truly generating wealth, how do you even begin to find them amidst the thousands out there? The expert strongly advises a top-down approach. Start broad.
That's right. The crucial first step is always to assess the total addressable market, or TAM. This means looking at an industry's potential for massive growth. You're seeking out those macro tailwinds, or what we often call sunrise industries. You really want to identify sectors with inherent, strong growth drivers, not just hope an individual company bucks a stagnant trend.
Okay, and he contrasts this with industries that are likely to remain stagnant, right?
Yeah.
Where those elusive 10x or 100x opportunities are far less likely. He points to examples like basic consumer goods, what he calls the parlay G economy.
Kind of the everyday essentials.
Yeah, where stable population figures and declining birth rates just limit that explosive growth potential. Similarly, things like basic education or school uniforms peak demand seems to have passed. And commodity industries like steel and cement. Essential, yes, but generally unlikely to be those long-term top performers for, serious wealth creation.
Precisely. Instead, the focus should shift towards sectors being driven by a country's demographic and economic transition. It's about spotting the big shifts. The expert draws parallels, for instance, with China's past consumption patterns, particularly highlighting the potential in luxury businesses. Think high-end watches, premium cars like Rolex or Mercedes. As per capita GDP rises, the demand for these discretionary aspirational goods tends to grow disproportionately faster.
Okay, that makes sense. So once you've successfully identified these promising industries, these big waves, then you drill down to the micro level. That's when the individual company analysis really begins.
Exactly. If we connect this to the bigger picture, once you're confident you're in a promising sector, then you scrutinize for good management, competent management, management with governance standards who don't steal basic but critical. And you also have to critically assess the competitive landscape. You want to actively avoid industries with very intense competition or those tangled in too many regulations because those things can just stifle innovation, growth, and ultimately profitability.
This really begs the question then. What's the practical implication of all this for your existing portfolio? What do you do?
Well, it means you must be prepared to ruthlessly cut losses when your initial assessment proves incorrect. You can't afford to hang on hoping. As the expert puts it, quite bluntly, every 100 I pull out of a bad company creates an opportunity for me to invest in a good one. This isn't just about preserving capital, it's about continuously, actively reallocating it to better, more promising prospects, freeing up that money.
And this really reframes that conventional notion of buy and hold, doesn't it? It's not about holding any stock forever. I mean, our sources remind us that something like 70–80% of companies that were in India's Sensex back in the 80s and 90s, they've just vanished, gone.
Completely disappear.
Yeah.
Or become irrelevant.
So buy and hold really means holding good companies, companies that continue to meet your criteria and knowing precisely when to exit. Even great ones, if their fundamental story changes drastically. Like the example given was the impact of Jio's entry on legacy players like Vodafone in the telecom sector. That changed everything for them.
Absolutely. Fundamentals shifted dramatically. And on a related note, traditional valuation metrics like, PE ratios, price to earnings, which mostly look backwards at past earnings, they are often just unsuitable for these new age or winner-take-all Indian tech businesses. Think Zomato or Paytm. These companies are often deep in an investment phase, right? Showing current losses or high cash burn. For them, the focus must be on their future growth potential, maybe 3 to 10 years out, and their path to market share capture rather than just immediate profitability. It's a different way of valuing.
Right, looking at the potential future size of the pie they could capture.
Exactly. Potential matters more than the past in those cases.
Okay, so applying this top-down lens, what specific sectors in India seem to hold significant promise right now? And conversely, which ones are facing strong headwinds in the coming years? What's your outlook based on these insights?
Well, based on this framework, I'm actually quite bullish on several areas. First, the wealth industry. That encompasses asset management and also luxury businesses. This is really driven by India's increasing per capita GDP and just general wealth accumulation. More money means more management and more spending on luxury.
Makes sense. What else?
Second, fintech. Why? Because India's leverage, measured as debt to GDP, is around 50%. That's remarkably low compared to, say, China's 170 and 180%. This signals potentially massive growth runway for loan providers and all the related financial technology that supports lending and payments.
Huge potential there. Okay, number 3.
Third, Indian tech, specifically what the expert calls local tech companies. These are businesses developing solutions specifically for India. They're often seen as potential winner-take-all businesses within their specific niches. And finally, maybe surprisingly to some, IT services. We're talking the legacy giants like TCS and Infosys.
Just all the talk of disruption.
Yes. The expert views this entire AI boom is a blessing to Indian IT services. The thinking is everything is going to be software. Business will expand. Yes, they might need lesser bench strength for basic tasks, but they'll likely become more profitable, focusing on higher value integration and consulting. It's a bit like how ATMs expanded overall banking services and access, even though they displaced some tellers initially. AI could do something similar for IT services.
That's a fascinating perspective.
Yeah.
Okay, so conversely, what about those industries with a less favorable outlook, according to this framework?
Well, as we touched on, those would likely include basic consumer goods, the Parlo G economy, basic education and school uniforms, many commodity industries, and telecom, which just remains plagued by intense competition and heavy regulation. Not much pricing power there.
Got it. Now, it's impossible to talk technology today without really addressing AI. You mentioned it with IT services, but zooming out. This brings us to the profound impact of artificial intelligence across all these sectors and beyond. What's the real story here from an investment perspective?
Yeah, it's described as a very, very powerful tool, primarily for productivity improvement across almost every sector imaginable. Well, yes, it may well displace some junior level jobs initially. The broader view is that it ultimately expands the overall business pie. It makes companies more efficient, more profitable, and actually creates new high value roles for skilled individuals who can leverage AI. That ATM analogy really holds up here, I think. AI is likely to transform industries rather than simply destroy jobs wholesale.
That's a crucial distinction, isn't it? It's about evolution, not extinction. Now, for individuals listening, what really stands out to me is the expert's advice to actively engage with these chatbots. He stresses, they're going to be your companions for life. That means getting comfortable with tools like ChatGPT, Claude, Gemini, integrating them into your daily work, your learning. Don't be afraid of them.
Absolutely, become proficient. And for India specifically, as a nation, our experts suggest the country will benefit significantly from AI, but perhaps not by trying to compete head-on in building the foundational large language models, the LLMs. That's incredibly capital intensive. Instead, the strategy might be to leverage the core AI development done by global powers like the US and China and focus on building a lot of products, services backed by the LLMs. So applications and solutions built on top of that core tech, playing to our strengths.
Interesting. Kind of like building apps on an existing operating system.
Something like that, yes. Leverage the platform.
Okay. Now, the market journey, as we all know, is rarely a nice, smooth upward line. How do we effectively navigate those inevitable periods of, well, euphoria and despair, especially when trying to apply this contrarian mindset we discussed?
Yeah, that's the tricky part. The current market, thinking about 2023, 2024, is in a rather curious state. Our source describes it quite evocatively with a Hindi phrase, oh, fakaraha, wuthakara, hai buthakaiga ab. It basically translates to, it's tiring us out, and it will tire us out a lot more. It suggests we're in a period of time correction. This is driven by the prior euphoria and somewhat expensive valuations, rather than a sharp, sudden collapse. And it's partly being propped up by global buoyancy, maybe preventing a deeper fall. He even cites the long 10-year period of market fatigue in India between 1992 and 2002 as a historical parallel for this kind of grinding sideways phase. It tests your patience.
Wow, a decade.
Yeah.
Okay, so what's the strategic play in that kind of environment?
At the broader market level, the strategy for active trading, according to the source, involves buying the market very fast during crashes.
Like decisively, when the opportunity presents itself.
And then selling slowly during those euphoric booms. Don't try to time the exact top.
Right. Conversely, though, and this is key, at the individual stock level, the advice is almost the opposite. You should buy promising stocks slowly. Average in, allow for feedback, build your position carefully. But You must be prepared to sell fast if your investment thesis breaks or the fundamentals seriously deteriorate. Don't hesitate then. That distinction between market-level reflexes and stock-level reflexes is absolutely crucial, isn't it? Buy the crash fast, buy good stocks slow, sell the boom slow, sell broken stocks fast.
Exactly. It requires different mental gears.
Okay, let's unpack this a bit more. What about asset allocation then? Between equities and bonds, especially in these tired, potentially sideways market conditions you're describing.
Well, speaking as a cyclical investor, the view presented is that for the next, say, 1 to 1.5 years, bonds most likely will deliver more than equity, or at least offer better risk-adjusted returns. And specifically, he recommends corporate bonds over sovereign bonds for most individual investors.
Why corporate over government bonds?
Because they generally offer higher returns, maybe 50 to 400 basis points more, which is 0.5% to 4% higher yield. And most individuals don't actually need the absolute instant liquidity that sovereign bonds provide. Corporate bonds are usually liquid enough for personal needs.
Right. But with corporate bonds comes credit risk. So a crucial piece of advice there is diversify.
Absolutely critical. It's vital to invest across, say, 8 to 10 different corporate bonds from different issuers and industries. This significantly mitigates the risk if one or two companies unfortunately default. Don't put all your bond eggs in one basket, even if one offers a really tempting yield.
Spread the risk. Got it.
And this actually raises another important point. Risk itself is intensely personal. It's not some universal objective phenomenon. It depends entirely on your circumstances. To illustrate, a 20-something with maybe fewer responsibilities and a longer time horizon perhaps can risk it all in equities, metaphorically speaking. They have time to recover, learn from mistakes. A 50-something investor, however, likely needs to be far more cautious. Maybe incrementally allocating new savings into corporate bonds to balance their portfolio, reduce overall volatility, and maintain some dry powder, some cash ready for future equity opportunities when they arise.
Different stages, different risk capacities. Makes sense. It's also worth remembering a rather blunt practical truth he touches on. There's really no romantic solution for a fundamental lack of funds.
Yeah, you can't invest your way out of not having enough money to begin with.
Exactly. Investing, at its core, is for surplus capital. Money you have after meeting your basic needs. If you don't have that surplus yet, the most effective solution isn't finding a clever investment trick, but focusing first on increasing your earnings.
First earn, then save, then invest. In that order.
Right. Now, beyond all these strategies, sector analyses, market timing ideas, the expert consistently emphasizes something perhaps even more fundamental, that the investor's greatest asset and often their biggest liability is their own mind. This is where the real battle for success is truly fought, isn't it?
Oh, absolutely. That battle against those primal forces of communal greed and personal fear is just central to successful investing. It's constant. If these powerful emotions are left unchecked, they inevitably lead to what's termed freak-out behavior. We all know the feeling.
And delving deeper into investor psychology, we uncover this fascinating, almost scary phenomenon. Freak-out behavior isn't just anecdotal, it's a documented pattern. Apparently, about 2% of otherwise intelligent, experienced investors irrationally liquidate all their positions precisely at the bottom of massive market crashes. Think September 2008, March 2020, driven purely by extreme panic, completely overriding their usual rational decision-making.
It's startling, isn't it, that even seasoned pros can succumb. The solution, then, according to our source, is self-awareness, or swadhyaya, the Sanskrit term for self-study. He strongly stresses, to fix anything in the market or in life, self-awareness is very important, self-study is very important, studying oneself is very important. This means diligently, honestly understanding your own behavioral patterns, your inherent biases. Are you naturally an optimist, a pessimist? Do you react too quickly? And critically, how do you genuinely react under extreme pressure? Maybe, keeping an investment journal could help here. Noting down not just your trades, but your emotional state during market swings. You might begin to map your own freak-out triggers that way.
That's a great practical tip. It's about cultivating that inner discipline, isn't it? That sort of guiding dad in you, as he puts it. Or perhaps finding a master, or a guru, a mentor, or a philosophy to help steer your emotional responses, like having a steady hand on the rudder during a storm.
Precisely. He even suggests choosing a god or a philosophical guide that truly fits your personality. For optimists, for example, who fundamentally believe in upward progress but maybe need to cultivate more patience, studying someone like a seasoned, long-term buy and hold investor might be beneficial. Learn their discipline. For cynics, though, people who thrive more on contrarian thinking, cyclical plays, active strategies, perhaps studying another influential, more active figure might resonate more. The key is finding a philosophy, a framework that genuinely aligns with your core psychological tendencies and helps you manage them.
Find your investing spirit animal, perhaps.
Something like that, whatever keeps you grounded.
The ultimate lesson here, then, wrapping this up, seems to be humility. Recognizing that success in the markets and frankly in life often involves a significant component of luck and external factors you don't control.
Absolutely. The expert warns, quite starkly, where ego comes in, one place where you will definitely be ruined is the market. You have to genuinely recognize that you know very little, relatively speaking, and the market, in its collective wisdom and sometimes madness, knows a whole lot more. Stay humble.
Yeah.
And therefore, active market participation, if you choose that path instead of indexing, requires constant vigilance. He repeats, alert, alert, alert. It's extremely energy consuming and time consuming. It is not a fun sport. It is serious business, a very serious business. And if you're not genuinely prepared for that intense level of engagement, that constant self-monitoring and emotional mastery, it's often far better and safer to simply invest in index funds or entrust your money to trusted professionals who do live and breathe this stuff.
That's very sound advice. Know thyself and know if this game is truly for you. Okay, finally, let's step back a bit. Beyond personal enrichment, beyond building wealth, what's the deeper purpose of money once you've achieved a certain level of financial security?
Yeah.
What's its true value then?
Yeah, it's a great question to end on. Synthesizing these insights, the core takeaway seems to be this. Once your basic needs are comfortably met, your family is taken care of, you live in a decent home, your secure money's true value, as our source explains it, lies in being an enabler to create. It stops being just about accumulation and becomes about transformation,
Right.
about building something.
It's about building something that can potentially outlast you, creating a legacy,
Mm-hmm.
maybe a business or a foundation or a franchise that can outlast me, as he says, and serve people well. It's about giving your accumulated wealth a purpose that goes far beyond mere personal gain. It's about maybe impacting the world, even in a small way, in a meaningful way.
A tool for creation, not just consumption.
Exactly. What an illuminating deep dive that was, really digging into the mind and the strategies of a truly successful investor. We've learned that markets aren't random, they have structure. We've learned that cultivating personal greed really means having the conviction to act when others are consumed by fear. We've explored that top-down approach to trying to find those rare 10x or 100x stocks, analyzing which Indian sectors seem poised for growth and which to approach with maybe more caution. And we've understood how to strategically navigate market cycles, even knowing when to allocate to bonds. But perhaps, for me at least, the most profound takeaway is the sheer importance of the inner game. That relentless pursuit of self-awareness and humility needed to master our own powerful emotions of greed and fear. The market, it seems, isn't just a place for transactions. It's this profound mirror, reflecting your deepest tendencies, your strengths, and your vulnerabilities. So as you continue on your investing journey, maybe the question to ask yourself is, how well do you truly know yourself, especially when the chips are really down? Your investing journey might just end up being your ultimate journey of self-discovery.